QuantumScape Corp closed its last regular trading session on Tuesday, May 19, 2026, at exactly $7.30 USD per share, marking a downward daily swing of 3.57% as the market continues to recalibrate its expectations for pre-revenue technology firms. This means as we sit here right now on Wednesday morning, May 20, 2026, ahead of the opening bell, the equity is coming off a choppy session that saw an intraday high of 7.54 USD and a structural low of 7.13 USD. While a typical glance at the charts suggests this is just another standard volatile day for speculative green tech, the true hidden layer under the hood is an unusual pattern of insider equity tracking. A Form 144 filing has just shown a structured vesting of 53,059 shares tied to restricted stock units, alongside planned insider sales by Chief Financial Officer Kevin Hetrick. In isolation, automated filings like this happen all the time across major tech hubs, but when it drops right after a fresh quarterly financial update, it creates a fascinating friction. Smart Capital is not just watching the top-line numbers, they are tracking how the internal leadership behaves as the company moves from lab benches to pilot assembly lines. The baseline expectation that many mainstream retail accounts share is pretty straightforward. People looking at standard investing sites or browsing options on a Robinhood app often view QuantumScape Corp as a binary lottery ticket. The common belief is that the company is either going to fully establish the gold standard for solid-state batteries, or it will burn through its remaining cash pile trying. This narrative has historically made QuantumScape Corp a favorite for retail self-investing profiles. It is the classic long-term thesis where you buy, hold, and pray for a massive automotive integration down the line. But the reality our deeper analysis reveals is far more complicated and nuanced than a simple win or lose setup. The actual market dynamic is governed by an ongoing tension between technical pilot validation and macro-financial sustainability. The capital markets are no longer handing out free passes to clean energy companies based on promises. Institutional traders using the Interactive Brokers platform or executing large block trades through high-end Fidelity investment setups are looking at precision metrics. They are focused on the cash burn rate, structural equipment spending, and the mechanical execution of the new manufacturing test lines rather than the broad long-term story. When you look closely at the recent stock movement, the numbers tell a story of careful positioning. The volume has shown noticeable spikes during days with broader electric vehicle sector momentum, but the stock has spent considerable time consolidating below its previous highs. Institutional activity over the past month indicates a highly selective approach. Large funds running comprehensive strategies through sophisticated tools like Schwab Intelligent Portfolios or corporate Fidelity brokerage operations are balancing their exposure. They are keeping a close eye on the broader macro environment, where elevated interest rates make capital-intensive research projects incredibly expensive to maintain. QuantumScape Corp managed to deliver a surprise in its recent first-quarter earnings report, showing a net loss per share of 0.16 USD, which actually outpaced the consensus estimate of a 0.18 USD loss. That slight beat provided a quick pop in aftermarket sentiment, but the regular trading sessions quickly dragged the price back down to earth. This tells us that the broader market is looking well past minor accounting variations and is heavily weighting real-world execution. Let us transition into understanding exactly what this enterprise does and how its fundamental engine is structured. Founded in 2010 and born out of research at Stanford University, QuantumScape Corp operates as a highly specialized development stage organization trying to change the physical reality of energy storage. Their business model bypasses traditional retail supply completely. They are not trying to build consumer electronics batteries or standalone commercial power packs. Instead, their entire corporate architecture is designed around licensing and joint venture manufacturing partnerships with global automotive original equipment manufacturers. The core focus is a proprietary solid-state lithium metal technology that completely eliminates the conventional graphite or silicon anode used in modern electric vehicles. By using an engineered ceramic separator material, their design allows a pure lithium metal anode to form naturally during the initial charge cycle. This approach is intended to provide a massive step change in spatial energy density, lightning-fast charging capabilities, and a structurally safer profile because it eliminates the volatile liquid electrolytes that make current vehicle packs flammable. To understand the scale of what they are attempting, you have to look back at their operational history and past financial statements. The business model received massive credibility boosts early on through heavy financial backing from the Volkswagen Group and prominent tech philanthropists. When the company went public via a special purpose acquisition company in late 2020, it briefly achieved an astronomical valuation that surpassed major legacy automakers, despite having zero commercial product and zero operational revenue. That period represented peak market euphoria, where the general expectation was completely detached from physical manufacturing realities. In the years following that public debut, the reality began to catch up as Wall Street realized that building a flawless ceramic separator at an atomic level without defects is an incredibly grueling engineering challenge. Past reports from late 2024 and throughout 2025 tracked their transition toward shipping initial prototypes, which they called the QSE-5 cells. These early versions demonstrated high cycle life retention in laboratory environments and were even showcased powering experimental electric motorcycles to prove physical viability. Yet, as any experienced individual brokerage trader will tell you, a working prototype in a clean laboratory is light years away from automated mass production. This brings us back to the crucial development that occurred earlier this year. In February, the company celebrated the formal opening of its newly installed Eagle Line facility in San Jose. This pilot line is designed to test the automated assembly processes needed to manufacture these cells at scale. This is where the true expectation versus reality battle is being fought. Retail investors buying shares through a standard online investment app might see a headline about a pilot line and assume commercialization is right around the corner. On the flip side, institutional analysts managing risk through Fidelity mutual funds or complex online investing strategies understand that setting up automated manufacturing equipment requires months of calibration, yield testing, and expensive refinement. The company is actively working with Volkswagen's battery unit, PowerCo, under a high-stakes agreement to establish large-scale production capabilities once the platform is fully validated. Comment below how many shares of QuantumScape Corp you currently hold in your portfolio right now. I am genuinely curious to see how many of you are holding this for the ultra-long term versus how many are just trading the shorter-term technical swings. Looking out into the near future, the roadmap for this stock is packed with both massive catalysts and severe structural risks. The fundamental opportunity hinges entirely on whether the Eagle Line can achieve the mechanical consistency needed to produce high-yield B-sample cells for automotive testing. If those automated lines can produce flawless ceramic separators without microscopic cracks or cell failures, the validating auto partners will move forward with full vehicle integration. That scenario would likely trigger significant buying pressure from institutional investors who use Fidelity trading platform software or advanced interactive brokers trading desks to catch structural turnarounds. However, the downside risks are equally intense and must be weighed carefully by anyone managing a self-investing account or looking for solid investment help online. QuantumScape Corp is burning cash at a significant clip to keep its clean rooms and assembly lines running. Because they have zero commercial revenue, their corporate survival depends entirely on their existing capital runway and their ability to secure dilutive secondary offerings or licensing fees if deadlines slip. If the technical validation of the commercial cells runs into manufacturing bottlenecks or design flaws, that cash runway will shrink rapidly. We are also operating in a macroeconomic landscape where large institutional players are rotating out of speculative pre-revenue names and parking capital in reliable cash-flowing assets like big tech giants or steady Fidelity ETFs. If the broader market experiences a liquidity contraction, highly speculative names are often the first to suffer severe multiple compression. When you synthesize this entire picture, the contrast between market expectations and operational reality becomes clear. The casual narrative surrounding QuantumScape Corp treats it as a simple bet on the future of electric vehicles, similar to how people trade Tesla stock or monitor Apple stock and Nvidia stock for broad tech trends. But professional money managers looking at detailed individual brokerage data recognize that this is a meticulous execution game where the margins for error are microscopic. The company has done an impressive job moving its solid-state ceramic technology from a theoretical Stanford project into a physically functioning pilot line, but the market has adjusted its timeline, realizing that multi-gigawatt-hour factory production is a multi-year process that requires massive capital, steady corporate governance, and absolute flawless manufacturing yields. To bring it all together, QuantumScape Corp remains an incredibly sophisticated science project that is actively trying to cross the chasm into a viable commercial enterprise. The recent stock movement reflects a market that is deeply conflicted. On one hand, you have better-than-expected quarterly loss metrics and the physical launch of the automated Eagle Line facility. On the other hand, you have regular insider sales, a challenging macroeconomic backdrop for pre-revenue firms, and the reality of a lengthy automotive validation cycle. Investors who approach this name through basic online investing platforms need to look past the sensationalized headlines and focus intently on the upcoming production yield updates. The long-term trajectory will not be decided by hype or broad sector enthusiasm. It will be dictated entirely by whether the company can successfully manufacture its unique ceramic cells at a scale and cost that makes sense for the global automotive industry. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.